joining us, St. Louis. This is What Retirement Means to You with Jerry Means, financial advisor, and he's the founder of the Means Financial Group. I'm Spike Spengel. Jerry, how you doing this week?
Hey, I'm doing great, Spike, as usual.
All right. What's on your mind? What do we need to cover?
Well, I thought today, we would talk about taxes. Some of the things, keep more, pay less, that kind of.
Oh, that's good. Yeah,
yeah.
I always like to keep more and pay a little bit less, if possible, as much as legally less we can pay in our own
That's
taxes.
Right. Tax avoidance, not tax evasion.
Exactly. But can we try to make this exciting and fun? When you start to think about taxes, I'm worried about people grabbing their remotes and changing their channel.
Yeah, who says taxes has to be boring? I mean, there's things that we can do to make it exciting. And by the way, keeping more and paying less, isn't that exciting enough?
It always is. Always is. Well, in fact, speaking of exciting, let's talk about the bill that was passed. When we were doing shows over the previous weeks, we talked about it maybe being passed. It has. What are some of the ins and outs of it?
Well, one of the biggest things for retirees, because this is what retirement means to you, is the $6,000 if you're a single filer and $12,000 if you're a joint filer to help offset Social Security. The goal of the bill originally was to try to avoid Social Security altogether, taxation on Social Security altogether. That didn't fly, but we found a workaround, and that's the $6,000, the $12,000. Now that is not permanent like the rest of the bill. That will expire in 2028, around election year, right? I don't think that was by accident.
Of course.
But that will help. I think 88% is the prediction is 88% of people on Social Security will not pay taxes due to this new deduction. So it's a pretty big deal, and there's a lot of planning that we can do around that to take advantage of that deduction. So that's one of the biggest things that came out of the bill.
All right, to break it down for our viewers out there, we're saying $6,000 and $12,000. It depends on if you're solo filing in retirement or married filing jointly. $12,000 for married filing jointly. What about our other deductions? Right now, I know that we currently have some of the largest standardized deductions per person, about $15,000 per year. Do we get to keep those as well over 65?
That's right. This is on top of the standard deductions. So it's a big planning opportunity for people. And believe it or not, a lot of middle Americans are not using all of their deductions, especially after the $6,000. So it's a great time to do withdrawals from IRAs and avoid the tax if they stay within those limits. Or to do Roth conversions, which can be a big thing down the road.
Right. We're going to discuss exactly what goes into the Roth conversion, how you can do it, who it's good for a little bit later in the program, so please don't go anywhere. But, all right, so we've got $6,000 and $12,000. That's definitely one of the things that's in there. What else came about from the bill? So these things are going to go away. The tax rates, we were concerned those were going to go away here at the end of this year. What did they do with those?
So they extended those. The 2017 tax rates, so the rates that we've had since 2017, are still in place. Now, what I want the viewers to understand is when they say they're permanent until legislation changes again, right? So they're permanent until they're not. A lot of people think, well, that's, it's permanent forever. It's permanent until a new Congress or a new president comes in and tries to write a new bill to increase taxes. I do believe somewhere down the road, we are going to see an increase in taxes, but we're probably okay from now till 2028.
Right. One way they can avoid increasing any of our taxes is just to balance the budget, right? Just get rid of that little bit of credit card debt, that $37 trillion they've got, and then we don't have to worry about taxes. So we know that these tax rates, which, by the way, folks, are about the third lowest in U.S. history, we're going to have those until at least 2028. Probably 29 or 30 or so, because it takes a little while to change a tax law. So that gives us 4 or 5 years, plus those other deductions, to get tax efficient. I don't know if our viewers are catching it yet, but that's pretty exciting.
Yeah. We all complain about taxes. No one likes to pay taxes. I have a chart that I show people when I do my live workshops, and it shows the history of taxation, across different decades. And World War II veterans, that era, we always call them the greatest generation, not just because of what was going on and what they did, but if you even look at tax rates back then, the highest earners back then paid a 92% federal tax rate. Believe that, 92%. It's hard to believe, right?
Yeah.
But that was the highest. That was the highest earner. I know, right? That's why they're the greatest generation. So today, tax rates are, like you said, the third lowest that we've ever seen. So it's a great opportunity for Roth conversions, to make withdrawals, to soften the blow down the road for required minimum distributions. And those are all things that we help people out with in our office.
Something we've done on a couple other programs, so we want to remind people, you've put together an absolutely free tool. And when we say free, we mean free.
That's correct.
Your tax tool, and again, we're going to discuss how we got here. There's trillions of dollars in tax-deferred accounts. Tell them about Mean Taxes.
Yeah, so if you go to meantaxes.com or you click on the QR code on your screen, it'll take you to a landing page. It asks a few basic questions. You can put in there how much is in your pre-taxed accounts, and it will tell you what taxes you're going to pay over time on those accounts. It's just the start of a conversation. You'll get a free report. It'll come right to your email. But what I recommend is once you see that and you start that conversation, give us a call. Let us walk you through the report. But also we have a more sophisticated system where we can show you how we can ladder those conversions over time and save you a lot of money so that you pay less and you keep more.
All right, meantaxes.com. You can either type that into your web browser, or as Jerry was just saying, you can scan this QR code with your phone over here. It'll take you right over there. Couple of simple inputs. Basically, what do you think you have saved in tax-deferred accounts and what you think your tax rate was. If you can't remember, kind of assume what it was from last year or the year before that. It's a little slider on there. And then you will get that report right away. But that's going to be a pretty big number. Do they have to pay all of those taxes at once?
No, absolutely. I don't recommend that you do that, but it just shows you, it opens your eyes to see what the taxes look like on the account. And again, it's just the start of the conversation, but it is a free tool. You have nothing to lose to go in there and check that out. And also, if you wanted to just give us a call, you can call the number on your screen. You can come in and sit down with us. There's no charge, no obligation to sit down with myself or a member of my team and to walk you through that report. Along with that, if you'd like, we can do what's called our on-track retirement report. We'll sit down and we'll look at the taxes that you're paying. We'll look at your income plan. Do you have a designed income plan? Not just a hypothetical, but a written income plan. We can look at the fees that you're currently paying in your account, and we can make sure that your risk is aligned with your current risk tolerance. You know, the market's been doing pretty well, but all things come to an end. So you need to be prepared before retirement. The last thing you want is to go into retirement and have a big market drop. So we need to make sure that your risk tolerance is aligned with your goals. So again, there's no cost, no obligation to come in and sit down and talk with myself or the team. 844-878-1293. Give us a call.
Jerry Means isn't going anywhere. We're going to give you a little bit of the history on taxes and how we got here, and more importantly, what you can do about it to help get Uncle Sam out of your retirement accounts. Call that phone number so we can get you started on your own on-track review, which will give you your on-track retirement report. More with Jerry Means right after this.
I was like most kids. I wanted to be, law enforcement or fireman or baseball player, of course, that sort of thing. But growing up, even at an early age, my grandfather was a big influence on me. He was kind of the monarch of the family that everyone went to, and if they had questions, they always went to my grandpa, and I was the oldest grandson. And I noticed that during the holidays, we would be at his house, and he had two living rooms, and one of the living rooms he always stayed in, and everyone else kind of gathered in the other room. And he was reading the Wall Street Journal and watching the stock market and, taking a look at where things were and talking to me about politics. We just had a really good relationship, and I took an interest in investing. So he taught me how to read the Wall Street Journal when I was 13 years old. So if you can imagine, I went to school, I knew more about investing than most of my teachers did. I knew what bonds were, what equities were, how the market worked. I still wasn't planning on getting in that line of work. It just was interesting to me. It was kind of a bonding time with my grandfather. And then fast forward into my early 20s, I got a phone call from a financial advisor that worked with my grandfather. And he said, hey, we're looking to recruit young guys that might want to get into business. And your grandfather said to give you a call. And once they showed me what they did, I thought, this seems like it would be a good fit for me. And 25 years later, we just celebrated our 25th anniversary in the business. So it was the right move for me.
Welcome back to What Retirement Means to You with financial advisor Jerry Means. He's the founder of the Means Financial Group, and we're trying to make taxes and retirement exciting. It can be fun. You're right, though. It can be fun when you're realizing that if you understand these tax strategies, you're saving more of your own money. But Jerry, how did we get to over $29 trillion in tax-deferred accounts? There's about $17 trillion in IRA savings for Americans, about 13 to 14 trillion in 401ks, close to $30 trillion. Why is everybody saving only tax-deferred?
Well, in 1978 is when they came out with the 401k plans, the 403bs, the 457 retirement savings plans. And employers started shifting away from pensions and putting it on their employees to kind of save in the plan and doing some matching. So for the last 4 decades, we've been doing that, right? My wife always teases me and says, I'm a creature of habit. I don't like change, right? So once you get in the habit of doing something, it's kind of automatic. So people are just saving in their 401ks, they're getting the matching. Although what I've seen recently is a lot of companies are getting away from the match. That's one of the ways that companies are cutting back.
Really?
Yeah, I'm seeing a lot of employers not matching the 401k anymore. So it's really important to know how much your employer is matching, how much you're contributing, and you want to contribute up to the match, because free money is free money, right? It's hard to beat. But the Roth 401k or the Roth IRAs came out in the 1990s. So people in the beginning weren't really paying attention to it. A lot more people today are paying attention. I mean, I used to see, 99% of the people that I would see didn't have a Roth IRA. Today, I'll see them, but they're usually smaller than the tax-deferred accounts because they started later on those plans. But I am seeing people start to contribute more. And I'd like to say, the people that I meet with, I encourage that because, the benefit of the Roth IRA or the Roth 401k is you put the money in, you're growing that money tax-deferred, and if you play by the rules, it comes out tax-free, not only what you put in, but all of the growth on those accounts.
Wow. And that's just been one of those mantras that I think everybody's been used to. We save in our 401k. That's what we're told to do. And I don't know if it's rumor mill. I don't know if it's from mom and dad. I don't know if it's from the community. But I'm glad to hear that a lot more people are hearing about the Roth version of it. One thing I want to ask you about, though, we also hear that phrase a lot. Well, I'm saving up to the match. Somebody comes into your office, how much you save? I've always saved up to the match. And that is good, and we want you to feel good about that. But is that going to be enough to save for retirement, just up to the match?
Well, but here's the thing. You can save outside of your 401k. When you put money into the 401k, one of the downsides of the 401k is you're very limited in your investment options. You have about 30, maybe 40 choices, if you're lucky, inside that 401k. To put that in perspective, Spike, there's 16,000 mutual funds out there. Over 16,000. There's over 60,000 individual stocks. Then you have bonds, ETFs, annuities, all of these different tools outside of a 401k, but yet you're kind of pigeonholed into 30 or 40 choices. And they're not always the best choices, but they had to make the plan simple, right? You can't give an employee 100,000 different choices to pick from. It's too hard to really regulate and monitor that plan. So my thing is contribute to the plan, take advantage of the free money, some of the tax deferral, which is tax savings today, but then invest outside of that account. We always talk about diversification, right? Don't put all your eggs in one basket. Don't buy too much of one stock or too much of one bond or one whatever. What about diversifying your tax buckets, right? So have some in your tax deferred account, have some in your Roth IRA account or Roth 401k account, and then have some in an after-tax account where the taxes are taxed at capital gains rates, which are much lower than ordinary income tax rates. So there's all these different things that you can do outside of that plan, but you definitely want to take advantage of the match.
I love that we're talking about the investment part of it, and we opened up with the taxes. Means Financial Group, financial advisor. How much do you help people with their taxes? Do you have a tax associate that you work with? Do you outsource it? Is this just part of a conversation today? Do you bring this into your plan?
We do. So we don't actually file the tax return. We have someone that we refer people to if they don't have someone to do that, or we have other accountants that we work with. If our clients have an accountant, we'll work with them. But to be clear, we don't file the tax return. We're doing tax, that's tax preparation before filing, right? We're doing tax planning. We're looking through the front windshield, not in the rear view mirror. We're looking forward and saying, okay, what can we do to make your next tax return you owe less, keep more and pay less, right? So we help people prepare for the next year or the coming years by doing some of these tax advantage plans. So we don't do the tax return, but we do the tax planning. We do that every day in our office.
All right. When you're also talking about then, if you're doing up to the match, feeling comfortable, you want to continue to save, not spend all of that money. What kinds of things are you talking about investing in the outside? Do you want people to have their own brokerage accounts and be playing the markets? Are you talking about tools that might be contract that can grow over time and provide income later? What kind of outside investing?
Yeah, so again, we just want to be able to have them diversify. And of course, we help them do that. We'll open up a brokerage account And we can help them manage the risk in their assets. We can help them put different strategies into those buckets. We can use things like annuities that have guaranteed lifetime income. We can do dividend-paying stocks, things that they don't have inside. A lot of those aren't inside of 401k plans. So again, there's all these tools that aren't inside that plan that we can help them inside a brokerage account do.
All right. Well, 54% of Americans have some version of retirement account, and for the most part, it's tax deferred. We hope that you're starting to hear us ring the bell about looking into the Roth version. Do you have a Roth 401k or saving into a Roth IRA? From what I understand, though, there's some limitations about being able to put money yourself into a Roth IRA. Is this based on income?
Yeah, so if you make too much money and you can't put money into a Roth IRA, there are income limitations. There is something called the backdoor Roth that we've helped people do.
It's
So
legal?
It's legal.
I'm hearing about,
It's
all right.
legal, but it's a legal workaround. And it's a strategy again. But basically, you can put money into a non-deductible IRA, traditional IRA. It's non-deductible. So again, when you put money into an IRA or a 401k, you get a deduction off of your income. If you put it into a non-deductible IRA, you're not getting that deduction. However, you can turn around and you can convert that IRA to a Roth IRA. So it's called the backdoor Roth is the common phrase for it. And you know, it's a great way for people that are high income earners to still get some tax-free accounts.
All right. Well, I want to bring that tool back up again, meantaxes.com. If you've been saving for 20 years, 25, 30, 35 years, you're probably like a lot of Americans, this $29 trillion in tax-deferred savings here in the United States. Eventually, you're going to start taking that money out, and you're going to have to pay the taxes on it in your retirement years. Now, we know that these tax rates are going to stay for the next few years. They're called permanent, as Jerry said. But if the debt continues to go up or stays the same, eventually we're concerned that tax rates will go up. So wouldn't you rather pay taxes at a lower rate now than wait down the road when you're going to need that money? So go to the meantaxestool.com. Right now it'll show you how much you have to pay in taxes. Then you can call the phone number. Come and sit down with Jerry Means, financial advisor who will also help you with these tax strategies. 844-878-1293 is the phone number. What can you do with your tax-deferred accounts to get Uncle Sam out? We're going to give you the solutions when we get back right after this.
We know the market is going to get worse from here. This is the biggest monthly decline in 10 years. People's 401ks took a major hit.
My investments are tanking. My retirement isn't going as planned. I can't believe I let my kid talk me into buying crypto. I mean, what is that anyway?
This was the fourth worst contraction in history.
So how are you two doing?
Your financial future doesn't have to be uncertain. I'm Jerry Means with Means Financial Group. If you've amassed a nest egg, it's time for a financial advisor to help you reach your retirement goals. This is one of the greatest tax windows in history. Now is the time to take advantage of this tax discount while you can. All of our advisors are fiduciaries, specialize in retirement planning, tax mitigation, estate planning, and more. Plan your retirement right. Call now for your own complimentary portfolio review and tax analysis.
Welcome back. You are with financial advisor Jerry Means of the Means Financial Group. This is what retirement means to you. You, the viewers out there in the St. Louis area, what can we do to help you get more tax efficient in retirement? So, solutions now. If we have a lot, primary amount of our savings in retirement in tax-deferred accounts, is there anything we can do?
Yeah, absolutely. Again, we can do the Roth conversions for sure. Also, it's never too late to start contributing to a Roth IRA.
Really?
No,
Okay.
never too late. I'll have clients come in and they're like, Jerry, you know, I'm 62, I'm 63. Why would I contribute to a Roth IRA? I'm not going to get the tax-deferred growth for very long. Well, it's not like you have to tap into that bucket first, right?
Mm-hmm.
People are living longer in retirement. They're living 20, 30 years in retirement. So if you're 62 and you live into your 90s, maybe you tap into the Roth IRA in your 80s, right? So you get it on the back end of your retirement. So you still could get 15, 20, maybe even 30 years of tax-deferred growth inside that Roth. So it's never too late to do a conversion or to start a Roth IRA and do contributions.
All right. I love the idea of if we're still working. So if you've got earned income, you can put into not only the Roth IRA, but into your Roth 401k.
Yep.
So you can find out what from your provider. Is that go log in online on Monday morning or give them a call to say, do we have Roth 401k?
Yeah, you can call your HR person, or a lot of today they're going on like their .net, benefits and going in there. They can make those changes there as well. Now, the important thing to understand is if the employer is matching the money that you're putting into a Roth 401k, the match usually goes into the tax-deferred account, though. It goes into the regular 401k plan, but it's still, again, it's free money. You're getting money into the Roth. So often I'll do a rollover with clients and into IRAs, either traditional or Roth. And while we're on this, we'll talk about the 59.5 rule. There's something called an in-service rollover, and I do this a lot with clients. And a lot of people still don't understand that it's available to them. Most plans, I would say probably 80-90% of the plans out there allow what's called an in-service rollover if you're over age 59.5. What that basically means is if you have a 401k, whether it's pre-tax or Roth, after age 59.5, you can set up a traditional IRA at a brokerage account or a bank or wherever it is, and you can roll that money out of your 401k into that traditional IRA outside of the plan or traditional Roth IRA. And the reason for that, again, is you have maybe 30 investment choices inside your 401k. So you're very limited in your diversification. They realize that when you get to be about age 60, retirement's right around the corner, and that you might need more options than what your 401k offers. So why not take that money out of that bucket, put it over here where you have a lot more choices. You can buy annuities that will generate lifetime income. You can buy dividend-paying stocks that can create income. All of these different things that you can't do outside your 401k, and you still have 4 or 5, maybe 6 years to plan for your retirement versus just keeping it in the 401k until, hey, I'm retiring next month. Now I need to do something different with my money. It gives you the opportunity to do that along the way. And what happens is when I call the companies, I do this with the client, we do it on the speakerphone, and I'll call and I'll say, hey, what's the account value as of yesterday's close? How much is pre-tax? How much is Roth? And a lot of times people will tell me, Jerry, some people have opted for the Roth that don't even realize it because they'll say, no, it's all pre-taxed. And more times than not, when I call the company, I'll ask how much is pre-tax and how much is Roth, and they'll have a little bit of Roth in there. And I'll say, okay, we want to do a rollover. Is that a paper liquidation or is that a verbal liquidation? Because some of them will do it right there on the phone. They'll send the client a text and they'll read the code back and they'll be able to do it then.
Wow.
Some of them require paperwork and we'll have that emailed over. I help them fill out the paperwork, but they'll send 2 checks. They'll send one for the pre-tax and one for the Roth. So we open up those 2 different accounts. But it really allows me to help people plan because, not that I can't help them if they come to me in the 11th hour, but it's a lot easier for me to plan out a strategy for them if they say, hey, I'm 60 years old or 62 years old. I want to roll over my 401k, put some strategies together versus, hey, it's October, I'm retiring in January. I have this money in my 401k.
How did I do?
How did I do? What can I do to plan for next year? I can still help them, but of course it's much easier if I have some time to do that. So make sure that you're taking advantage of that in-service rollover. And when I'm on the phone, I always ask for the client. I already know the answer, but I do it for the benefit. And I'll say, hey, does this hurt the employer at all? Is the employer going to be upset? Can they still keep contributing to their 401k and get the matching? And all of those answers are always, positive. Yeah, no, it doesn't. This is here for your benefit. People just aren't aware of it. So you basically empty the 401k. I call it sweeping the account. And it's funny because I'll have clients come in and say, hey, Jerry, I think it's time to sweep my account again. They kind of pick up the they pick up on the terminology, but we sweep the account. So the money's just moved over here where we have more choices. You start with a 0 account balance again, but you still can contribute and you can still get the matching. So it's a really good way to help plan for your retirement.
And real quick on that, when you make a call and you're going to say, we're going to roll this over, we're going to sweep it over into this account, is there a tax consequence for doing that? Sometimes people might say, I don't want to transfer over a big account. I'm going to have to pay all the taxes on it.
No, they're going to get a 1099-R the following year, and the R stands for rollover. And when they look at the 1099, because I've had people call me and like, Jerry, I thought this was a non-taxable event. And I'm like, it is. And they'll say, but I got a 1099. I say, well, if you really look at it, it says 1099-R. The R is for rollover, but it also has taxable amount 0. So yeah, it's a non-taxable event to do that.
All right. Now with a Roth conversion, Is this also something we want to wait for 59 and a half? Do we want to wait until we're over an age where there could be a tax penalty? Does it matter as much on a Roth conversion?
It doesn't. So it's not going to be a penalty to do a Roth conversion.
Okay.
Now you will pay taxes whatever amount that you convert from traditional pre-taxed accounts to the Roth, whatever that amount is, you're going to pay taxes on this. So you have to be very careful because it can bump you into the next bracket. And if you're close to age 65, you're going to be drawing Social Security and get on Medicare. If you do too much, it can trigger what's called IRMA, which is a surcharge on your Medicare Part B premium. So you want to make sure you stay under those limits. We have a software program that we use to help show people how much they can convert each year and how it's going to affect them.
Yeah, but going from, let's say, the 22 to 24% tax bracket, if you did go all the way up on that, because there's usually anywhere from $50 to $100 to $150,000 worth of room in between the tax brackets. So you could do what, a Roth conversion of $50,000 or $100,000 and try to stay within your bracket?
That's right. Yep.
Okay.
Absolutely.
So you don't have to do this all at once. In fact, you probably don't recommend.
I don't. It's going to be over a period of time.
All right. So once we've done that Roth conversion, boy, it's like two things in one here. You can do the in-service rollover, then we can start doing some Roth conversions, and you'll walk people through all of that process?
That's right. When people come into the office, we're going to sit down with you. We're going to talk about your tax return, what kind of taxes you're paying. We're going to look at the fees in your account. We want to make sure you're not paying any excessive fees. We want to look and see, do you have an income plan? What are you going to do in retirement? How are you going to draw money? You've saved your whole life. How do you turn that into an income stream that you can't outlive? We can sit down and do a written plan for you and help you with that. We want to make sure that you're diversified, not only in your stocks and bonds and mutual funds, but also in your different tax buckets. And again, we'll help you with the tax conversions. We'll make sure that you don't trigger an IRMA if it's possible to do that. So please give us a call, come in, sit down with myself or a member of my team, 844-878-1293. There's no cost, there's no obligation. Just sit down and get your free on-track retirement report. We're happy to do that for you.
Jerry Means, thank you so much for talking so much about taxes today, and I hope we made it exciting or fun to you, or at least understandable and clear. It was up here before. I'll just reiterate it, meantaxes.com. If you want to type that into your browser, meantaxes.com. That's the free tool that'll tell you exactly how much you owe in taxes. And once you've gone through the calculator, you can call the phone number here, 844-878-1293, to get your own written report for your retirement review. Thank you so much for watching us. We'll be back again next week.